This video explains the key proposals in Sections of International Nonprofit Accounting Guidance, Exposure Draft 3, that are not covered by the other videos in this series. The other videos cover fund accounting, expenses and supplementary information, including donor reporting. INPAG uses the IFRS for SMEs accounting standard as its foundational framework. Prioritized topics have been reviewed in detail. The remaining sections have to be considered for consequential amendments to align with the reviewed sections. To be clear, these remaining sections have not been reviewed in detail. Exposure Draft 3, or ED3 for short, introduces a number of sections. These are fair value measurement, investments in associates, joint arrangements, investment property, property, plant and equipment, intangible assets other than goodwill, business combinations and goodwill, leases, liabilities and equity claims, impairment of assets, related party disclosures, and specialized activities. ED3 also includes important guidance about the transition to INPAG. We are also sharing updates to previously published sections where there have been amendments to take account of feedback on ED1 and decisions made during the development of ED3. ED3 also includes additional draft guidance recently published by the International Accounting Standards Board. To ensure consistency, we've implemented common editorial changes across all sections. Firstly, INPAG includes terminology changes to use terms that are more specific to nonprofit organizations, or NPOs. For example, the word entity is replaced with NPO, and the term profit or loss is replaced with surplus or deficit. Secondly, the names of some primary financial statements have been changed. INPAG proposes to have a statement of income and expenses and a statement of changes in net assets. The statement of comprehensive income has been omitted. All references to financial statements have been amended accordingly. Thirdly, there are some consequential changes as a result of amendments to other sections. These editorial changes ensure alignment across INPAG and consistency with the proposals in Exposure Draft 1 and Exposure Draft 2. The topics in ED3 have been broken into groups for the purpose of this video. Firstly, are the topics related to fair value measurement and impairment. Secondly, topics related to equity. And thirdly, topics related to other entities in which an NPO has an interest. The remaining topics are then covered before the final section on guidance for NPOs transitioning to INPAG. The first group of sections relate to the use of fair value measurement and impairment. Included in this group is Section 12 on fair value measurement, Section 16 on investment property, Section 17 on property, plant and equipment, Section 18 on intangible assets other than goodwill, and Section 27 on the impairment of assets. Section 12 provides guidance on how to measure assets and liabilities using fair value. In essence, fair value is the estimated price at which a good, service or asset is bought or sold when the buyer and seller freely agree on a price. It is a rational and unbiased estimate that takes account of factors like the replacement cost and supply and demand. These steps create what is referred to as an orderly transaction. Fair value can also be used to estimate the amount needed to settle a liability. Exposure Draft 2 included proposals for revenue accounting that makes use of fair value measurement. Where assets are donated, they are measured at fair value on initial recognition to determine a deemed cost for the asset. This approach to measurement covers donated inventories, investment property, property, plant and equipment, and intangible assets. While this section was not subject to detailed review, to support the INPAG proposals, ED3 contains new application guidance and 2 new illustrative examples. INPAG includes a hierarchy for fair value measurement. The highest priority is given to Level 1 inputs, where there are quoted prices in active markets for identical assets and liabilities. If an NPO holds listed stocks or shares for investment purposes, this would be level 1 on the hierarchy. Level 2 inputs come from quoted prices for similar assets. For example, if NPOs have investment properties, these could be valued by looking at the prices of similar properties in the area. Lowest priority is given to level 3 inputs, where the inputs to the valuation are not observable. They are not observable because they don't come from quoted prices or other publicly available information. Many assets held by NPOs are expected to be measured using level 3 category of information because they have been donated or are held for delivering the NPO's objectives rather than for commercial purposes. The information used for measuring these assets will require elements of estimation and judgments. This hierarchy of inputs also applies to liabilities. For level 3, there are 3 widely used valuation techniques. These are the market approach, the cost approach, and the income approach. The cost approach is the technique most likely to be used for measuring donations in kind at fair value. Importantly, this technique takes account of the value of the asset to the NPO in terms of its capacity to serve the NPO's missional purposes. This concept is called service potential. When measuring an asset's service potential, its current location and technical specification are not considered. For example, a donor may provide office space, which the NPO cannot sublet. The office space has a specification that is greater than the NPO needs for its operations. As this office space cannot be sold or used by anyone else, it is the service capacity that is relevant, not the commercial value of the office space. The fair value will therefore be determined with reference to office space that would meet the operational needs of the NPO. Fair value measurement also applies to donated services in kind. For example, a doctor based in country A may give their time to train doctors in country B. The fair value of this donated time is calculated with reference to the cost of employing a doctor with equivalent experience in country B. The actual salary of the doctor in country A is not a factor in determining the fair value. An NPO may use the replacement cost, which provides the value of an equivalent item in local use, termed its value in use. Alternatively, an NPO may use the cost to the donor as the deemed fair value, where this is known and is relevant. Where an NPO is operating in a crisis situation, it may be impracticable to determine a fair value, particularly for inventory it is receiving. Due to these pragmatic constraints, such items are not required to be recognized in the financial statements, but disclosures must be made instead. Whether donated or not, many assets held by NPOs may be difficult to value. This may be because they are unusual in nature, heritage assets such as historical sites, or simply because they do not generate cash flows. INPAG clarifies that the cost approach is to be used for these assets. This results in a value based on the current cost to replace the service capacity of an asset. INPAG provides additional guidance where there is a restriction on how it can be used. The fair value is based on its highest and best use, with those restrictions in place. For example, if an NPO has been donated land that can only be used for a children's park, no account can be taken of the possibility of the land being used for a housing development. This possibility can be reflected in the fair value only when the restriction has been removed, and the NPO can freely sell it. Section 16 sets out the accounting treatment of investments in land or buildings, where these are held to generate rental income or for their capital appreciation. This does not include property held to deliver an NPO's missional objectives, so this section does not apply to property such as social housing. Purchased investment property is measured at fair value, where it can be measured reliably without undue cost or effort. Otherwise, it is measured using the cost model in Section 17 Property, Plant and Equipment. Where an NPO receives a donation of investment property, it is measured at fair value to establish its deemed cost. Some property assets could be multi-purpose, partly an investment property and partly property for use by the NPO. The property needs to be separated and valued based on the primary purpose for which each part is held. Section 17 specifies the accounting for property, plant, and equipment, which are also known as tangible fixed assets. It covers capitalization and depreciation. It applies to all tangible assets that are held for use in the activities of the NPO and are expected to be used during more than one reporting period. As previously discussed, this section also applies to investment property that is used for service delivery or whose fair value cannot be reliably measured without undue cost or effort. Section 17 permits assets to be measured using either a cost model or a revaluation model. Each model has advantages and disadvantages. The cost model is simple to apply, while the revaluation model allows a measurement that takes into account the value of the asset to the NPO. NPOs can decide which is most appropriate. When NPOs receive donations of property, plant, and equipment, these are measured using fair value on initial recognition to establish a deemed cost. In INPAG, assets are recognized when they meet the definition of an asset. In some jurisdictions, it is common practice to expense grant-funded assets. To be clear, INPAG contains no exceptions for assets that are funded by grants or donations. All grant-funded assets must be capitalized if they meet the definition of an asset in Section 17. This also applies to investment property and intangible assets. Depreciation or amortization is included as an expense in the same fund where the asset sits. For purposes of reporting to donors, there is a standard format in INPAG Practice Guide 1, Supplementary Statements. It includes the option to remove depreciation or amortization and show capital expenditure on the acquired or purchased asset, which is a preference for many donors. Further information can be found in other videos in this ED3 series. Section 18 sets out the accounting for all intangible assets other than goodwill. An intangible asset is an identifiable, non-monetary asset that does not have a physical substance, e.g. licenses or software. NPOs can receive donated intangible assets, for example rights to royalties from a book. INPAG requires that donated intangible assets are measured at fair value on initial recognition. This establishes a deemed cost for the donated asset. Section 27 provides guidance on the impairment of assets. An impairment occurs where the carrying amount of the asset is higher than its recoverable amount. In these situations, the carrying amount is reduced to the recoverable amount. In INPAG, the recoverable amount takes account of other economic benefits and service potential, as well as any cash generated when assessing the value and use of an asset. In Exposure Draft 2, there was a proposal for a new measurement base for inventories that are held for distribution at no or nominal cost. It proposed that this inventory is measured at its cost, adjusted for any loss of service potential. This new measurement base has been added to the requirements of this section. When making assessments for impairment, the IFRS for SMEs accounting standard refers to cash-generating units. This allows the assessment of a group of assets in situations where it is not practical for an individual asset to be assessed for impairment. In INPAG, the term cash-generating unit has been changed to operating unit. This specifically allows the inclusion of assets that do not generate cash, because they are held for missional purposes rather than cash generation. An operating unit is defined as the smallest identifiable group of assets that includes the asset being impaired, and that is operated independently from other assets or groups of assets. Moving on, in this next block of topics, we examine the revised proposals in Section 2 concepts and pervasive principles relating to net assets and equity. We will also look at the consequential impacts on Section 22, which is now called liabilities and equity claims. In a for-profit context, equity refers to the owner's entitlement to the net assets of the business. A survey we conducted in 2023 found that in the rare cases where NPO equity instruments exist, they do not generate any entitlements other than a return of funds put in. We had originally included equity as a financial statement element in Exposure Draft 1. But in response to feedback and the survey, it is now proposed to be removed. As the net assets of an NPO are held in a fiduciary capacity for service beneficiaries, it is proposed that the term net assets replaces equity as a financial statement element. Net assets is defined as the residual available to the NPO to achieve its objectives after deducting all its liabilities from its assets. This makes clear that the net assets are for those that benefit from the purposes of the NPO rather than those with ownership interests, as is the case in the private sector. In the rare instances where NPOs have some form of share capital or similar instrument, INPAG refers to these as equity claims. These are a subset of net assets. Equity claims are the financial interest in the net assets of an NPO that is due to equity claim holders. This reflects that the net assets are there for the NPO to achieve its objectives, and not primarily for distribution. Equity claims can provide an entitlement to distributions, or to any excess of assets over liabilities in the event of the NPO being dissolved. In some cases, this financial interest may be sold, exchanged, transferred, or redeemed. Use of the term equity claims is intended to create separation from how equity is used in the private sector. Significant amounts of equity claims are not likely to be consistent with an entity being an NPO. Section 22 establishes the principles for classifying financial instruments as either liabilities or equity claims. As discussed, the term equity is not used in INPAG, and Section 22 has been amended to reflect the use of equity claims instead. It also includes important clarifications. Where an NPO issues membership shares that provide no entitlement to the NPO's net assets, they are not equity claims and instead are to be treated as liabilities. Funds received by an NPO that provide the donor with governance rights, but do not establish a financial interest in the net assets of the NPO, are not equity claims. Guidance has been removed from Section 22, where it related to the use of equity claims for their trading value, as well as share-based payments. This next block of topics relates to Section 14 Investment in Associates, Section 15 Joint Arrangements, and Section 19 Business Combinations, including goodwill. Sections 14 and 15 provide guidance on accounting for associates and joint arrangements respectively. An associate is an entity over which an NPO has significant influence, but is not controlled by the NPO, or is not a joint arrangement. A joint arrangement is where the NPO and other parties to the arrangement share control of that entity. No major editorial changes are proposed for either of these sections, other than to reflect the relationships that an NPO may have with these types of entity. Section 9 on consolidated and separate financial statements, which was in Exposure Draft 1, will be useful in making assessments about interests in other entities. Section 19 of INPAG applies to NPOs that combine with other entities, including where they merge operations with another NPO. The purpose of this section is to provide guidance about how to recognize and measure the assets and liabilities acquired in the combination. While the idea of running a business may not resonate in a non-profit context, the term as defined in INPAG establishes principles relevant for NPOs. A business is defined in terms of an integrated set of activities that must have an input, and processes applied to those inputs to be able to create an output. The characteristics of a business now include the types of activities carried out by NPOs, for example, providing services to service beneficiaries. The section also covers NPO combinations that are motivated by an NPO's missional objectives, not just financial considerations. To make it easier to apply, a simplification has been added to cover the situations where two NPOs that both have positive net assets combine. Additional procedures have been removed, as the cost of applying these are considered to be disproportionate to the benefit. There are 5 other topics included in Exposure Draft 3. Sections 7 and 30 were included in previous exposure drafts, and have been updated to reflect additional proposals made by the International Accounting Standards Board. There are no proposed changes to Section 20 on leases and Section 34 specialized activities, other than for editorial purposes. The fifth section is Section 33 on related parties. This was partly covered in the ED3 video on expenses. Section 34 on specialized activities includes guidance on 3 types of specialized activity: agriculture, extractive activities, and service concessions. No adaptations have been made to this section, but feedback is requested on whether any of these activities are relevant to NPOs. Additional text was published by the International Accounting Standards Board on the 28th of March 2024 in the addendum to the draft 3rd edition of the IFRS for SMEs accounting standard. It is included in ED3. There are new disclosures in Section 7 on the statement of cash flows for supplier finance arrangements. These are arrangements that provide NPOs with extended payment terms or NPO suppliers with early payment terms. There is also additional guidance for Section 30 on foreign currency translation. This covers the procedures to be followed to estimate the spot rate when a currency is not exchangeable. It also includes disclosures about estimates and impacts relating to foreign operations. Disclosures about related parties are required to draw attention to the possibility that an NPO's financial position or its surplus or deficit have been affected by transactions between the NPO and a related party. It is common that oversight and control of an NPO is exercised by a separate governing body, often volunteers, who are not employed by the NPO. These can be known as trustees, board members, or similar. NPO governing body members are considered in INPAG to be a related party, whether or not they are paid. NPOs must consider whether their governance arrangements result in other related parties. INPAG does not require the disclosure of transactions with governing body members where any grants or donations they make or services they receive are made as part of an arm's-length transaction or received on the same terms as other eligible service recipients. As noted in the video on expenses, new disclosures have been added about personnel compensation and out-of-pocket expenses for these governing body members. Grant providers are generally not related parties. However, if the funds that they provide are significant to an NPO, and they are able to exert influence over the NPO's total operations, they may be a related party. The final section of this video looks at the guidance for those NPOs adopting INPAG for the first time. Section 38, Transition to INPAG, applies to any NPO adopting INPAG for the first time. It sets out the requirements for recognizing and measuring assets and liabilities to create an NPO's first statement of financial position that is compliant with INPAG, and for the narrative report. In adopting INPAG for the first time, NPOs are required to provide comparative information for the previous reporting period. This means that accumulated funds that contain historic surpluses and deficits must be split between funds with restrictions and funds without restrictions. The requirements are based on the importance of transparency over balances on funds with and without restrictions, and the need for narrative reporting, both of which have been emphasized by stakeholders. The date of transition to INPAG is the beginning of the earliest reporting period for which the NPO provides full comparative information in the financial statements. A transition period is permitted if required. This allows confirmation of compliance with the requirements to be made only for the financial statements, without the narrative report, for the first 2 years. The narrative reporting requirements must be met within 2 years of the first financial period, for which compliance with the financial statements is expressed. Compliance for the financial statements only will not be possible after this point. Section 38 also allows those NPOs that are not yet able to express compliance with INPAG to explain whether they have adopted any parts of INPAG and their plans for achieving full compliance with INPAG. All assets and liabilities that are required to be recognized by INPAG must form part of the opening balance sheet. This includes the assets and liabilities that relate to enforceable grant arrangements, EGAs, To ease transition, there are specified transactions that do not require the retrospective application of INPAG. For example, only grant arrangements that are due to be completed more than 12 months after the date of transition to INPAG need to be included in the opening balance sheet. So if an NPO has a transition date of the 1st of January 2026, and it has a grant arrangement that is due to be completed in that year, this grant arrangement does not have to be reflected in the balance sheet. Only grant arrangements that are due to complete after the 31st of December 2026 need to be reflected. This applies to all grant arrangements, as they impact assets, liabilities, and fund balances. Fair value measurement can be used to create a deemed cost for specified assets and liabilities where these were not previously recognized. This includes property, plant, and equipment, heritage assets, endowment funds, and inventory. All loans that have been provided at below market rate of interest must be recognized using the requirements of Section 11 Financial Instruments. This video describes a limited number of amendments across several sections that have been made as a consequence of changes to other sections of INPAG. These sections have not been reviewed in depth. Donated assets can be significant for NPOs. Sections 16, 17, and 18 have been updated to clarify that the initial recognition of donated assets using fair value creates a deemed cost for donated assets. As fair value is significant to donations in kind, additional application guidance has been developed, clarifying how to apply the fair value measurement requirements. The term equity has been removed as a financial statement element and replaced with net assets. Equity claims has been added as a term to describe equity instruments. Amendments have been made to the section on business combinations to clarify how its requirements apply to NPOs. Finally, we describe the requirements for any NPO transitioning to INPAG. This includes a transition period to allow the adoption of narrative reporting requirements and clarification about how the requirements apply to NPO-specific transactions. We look forward to hearing your feedback on these proposals. To respond, visit www.ifrfornpo.org/have-your-say. The invitation to comment includes questions on particular areas where we would like to have feedback, but comments are welcome on any aspects of the proposals. Download a template response document and upload your completed response or comment letter. Responses must be in English. The deadline is the 16th of September 2024.